Okay, so you want to own a McDonald's. No, not the actual company, obviously, assuming you're not a billionaire, just a local franchise, one that is going to bring in a nice cash flow. Well, let's get into the numbers and details. McDonald's makes more money from rent than it does from hamburgers. Not as a joke, not as an exaggeration, structurally, deliberately, by design. The company that taught the world to associate its name with cheap food has quietly built one of the largest commercial property empires on the planet, and the person standing behind the till frying your fries is, in a very real sense, paying McDonald's Corporation rent to do it. That single fact rewires almost everything you think you understand about how a McDonald's actually makes money, and it's the reason nearly every one of the roughly 40,000 restaurants wearing those golden arches isn't owned by McDonald's at all. So if McDonald's barely runs its own restaurants and the franchisee takes on almost all the daily risk, why do people still queue up, mortgage their homes, and hand over life savings for the right to run one? What's actually left over once McDonald's has taken its cut? Let's start with what a McDonald's franchise actually is, because the arrangement is more layered than most people assume. When someone becomes a McDonald's franchisee, they're not simply buying a business in a box, they're entering into two separate but linked agreements. The first is a franchise agreement, which grants the right to operate under the McDonald's brand, use its systems, recipes, training, and marketing for a term that's typically 20 years. The second, and less commonly discussed, is a lease, because in the majority of cases, McDonald's Corporation itself owns or controls the land and the building, and leases that property to the franchisee as part of the deal. This is the part that surprises people most. McDonald's isn't just a burger company that happens to franchise its stores. It's a real estate company that happens to sell burgers as the mechanism for filling that real estate with paying tenants. The company selects sites with extraordinary care, using decades of data on traffic patterns, demographics, and visibility, buys or leases the land, builds or approves the building, and then rents that finished, de risked property to a franchisee at a markup. It's a strange but brilliant structure because it means McDonald's earns steady, predictable income from rent, regardless of exactly how good any single franchisee is at running the restaurant day to day, as long as they're covering the basics. Becoming a franchisee in the first place is not a cheap or casual decision. McDonald's typically requires a substantial portion of the total investment to come from the franchisee's own funds, non borrowed liquid capital rather than debt, which alone tends to run into the hundreds of thousands of dollars in the US, though this varies significantly by country and by the type of restaurant being taken on. On top of that sits an initial franchise fee paid directly to McDonald's for the right to use the brand and system, plus the cost of equipment, signage, seating, kitchen fit out, and initial training, which together with the franchise fee typically pushes total initial investment for a new restaurant into the range of $1 to $2 million in the US and can run higher depending on location, size, and whether it's a new build or an existing restaurant changing hands. These figures vary considerably by country, currency, and local market conditions, so treat them as an illustrative range rather than a fixed price tag. Once the doors are open, the ongoing payments to McDonald's Corporation don't stop. They simply shift from a one-time fee to a continuous share of revenue. Franchisees typically pay an ongoing royalty calculated as a percentage of monthly gross sales, usually in the region of around 4 to 5% in most markets, alongside a separate contribution to a national or regional advertising fund, often somewhere around 4% of sales as well. And then, critically, there's rent, and this is where it gets genuinely clever from McDonald's side, because that rent is frequently structured not as a flat monthly fee, but as a percentage of the restaurant's sales on top of a base amount. That means as a restaurant's sales grow, McDonald's rental income grows right alongside it, without McDonald's having to do any of the actual work of flipping burgers or managing staff that day. Put those three payments together: royalty, advertising contribution, and percentage rent, and a meaningful slice of every dollar that crosses the counter is already spoken for before the franchisee has paid a single member of staff or bought a single potato. So where does the franchisee's own profit actually come from once McDonald's has taken its share? It comes from running the operation itself extremely efficiently because the margin for error is thin. Revenue flows in from food and drink sales across the counter, the drive-thru, and increasingly delivery and mobile ordering. And from there, the franchisee has to cover the cost of goods, the actual food, packaging, and ingredients, along with staff wages across kitchen and counter roles, utilities for equipment that runs constantly, ongoing maintenance and cleaning, local marketing on top of the national ad fund contribution, insurance, and its own general operating costs. After royalty, rent, cost of goods, and labor, a well run individual restaurant might realistically retain something in the region of 10 to 15% of sales as pre tax profit, though this figure swings considerably based on location, local labor costs, sales volume, and how many restaurants that franchisee actually operates, and should be treated as a general illustrative range rather than a guaranteed outcome. That last point matters enormously because very few McDonald's franchisees own just one restaurant. Because the fixed and semi fixed costs of running a franchise, training, systems, local management overhead, spread more efficiently across multiple locations, McDonald's has increasingly favored franchisees who operate several restaurants at once, sometimes dozens, within a single region. Owning multiple restaurants means shared management staff, shared purchasing efficiencies, and the ability to move trained employees between locations as needed, all of which improves overall margins compared to running a single, isolated restaurant on its own. This is arguably the real path to serious profitability in this system. Not one restaurant done extraordinarily well, but a small portfolio of restaurants run competently and consistently. Labor costs deserve particular attention because they represent one of the largest and most volatile expenses a franchisee faces, and one almost entirely outside their control. Minimum wage increases, which vary by country, state, or city, directly and immediately affect the cost base of every single restaurant. And because menu pricing is heavily influenced by both local competition and, in many markets, guidance from McDonald's Corporation itself, franchisees don't always have full freedom to simply raise prices to offset rising wage costs. Squeeze the labor cost up and hold the price down, and the franchisee's margin is the part that absorbs the difference. And this is where the tension at the heart of the entire franchise model becomes obvious. McDonald's Corporation earns royalty as a percentage of sales, and rent frequently structured the same way, meaning its own income is protected and even grows whenever sales rise, regardless of whether the franchisee's actual profit is rising at anywhere near the same rate. If food costs spike or wages rise sharply, or a local recession dampens footfall, while costs stay stubbornly high, McDonald's still collects its percentage of whatever sales do come through the door. The corporation's revenue is tied to top-line sales. The franchisee's profit is tied to what's left after every single cost is paid. Those are not the same number, and in a difficult year, that gap can be the difference between a franchisee having a comfortable year and barely breaking even. And there are real risks layered on top of that structural tension. Economic downturns reduce discretionary spending on eating out, even at relatively affordable price points. Rising input costs for beef, potatoes, cooking oil, and packaging squeeze margins that are already thin. Labor shortages in many markets have pushed wages up faster than menu prices have historically moved. Real estate costs and local rents, where McDonald's isn't the landlord itself, can rise over the life of a 20-year agreement. Changing consumer habits, particularly the shift toward healthier eating and the rise of fast casual competitors, put pressure on volume. And increasingly, delivery platform commissions eat into margin on any order that comes through a third-party app rather than through the counter or the drive-thru directly. Let's walk through a simplified, illustrative example, purely to make these numbers tangible. Not a real restaurant, just a realistic composite based on the general ranges discussed, since actual figures vary enormously by country, location, and individual restaurant. Imagine a single restaurant generating around $3 million in annual sales, which is a broadly reasonable figure for an established, well-located U.S. restaurant. Royalty at around 5% of sales takes roughly $150,000. The advertising fund contribution at around 4% takes a further $120,000. Rent, if structured as a percentage of sales alongside a base amount, might take somewhere in a comparable range again, depending heavily on the specific lease terms and location. Cost of goods sold, covering food and packaging, typically runs somewhere around 30% of sales, so roughly $900,000. Labor, another major cost line, might account for a further 25 to 30% of sales. After all of that, plus utilities, maintenance, insurance, and local costs, A well-run restaurant at this sales level might retain somewhere in the region of $300,000 to $450,000 in pre-tax profit for the franchisee, roughly in that 10 to 15% range mentioned earlier. Again, this is an illustrative composite, not a guaranteed return, and real results vary substantially by restaurant. So, where is this model heading? Digital ordering, mobile apps, and delivery integration have become central to McDonald's strategy over the past several years, changing not just how customers order, but how restaurants are staffed and laid out, with many newer locations built around dedicated drive-through lanes, mobile order pickup, and reduced dine-in seating altogether. Automation in the kitchen, from order-taking systems to food preparation equipment, is gradually reducing labor intensity in some functions, while creating new technical roles in others. McDonald's has also continued to lean into smaller format restaurants in some markets, prioritizing drive-through and delivery over large dining rooms, which changes the underlying real estate economics of the whole model. And the fundamental tension between corporate revenue tied to sales percentages and franchisee profit tied to actual costs isn't going away. If anything, rising labor and input costs in many markets are making that tension more visible than it's been in decades. None of this means the franchise model is broken. It means it's evolving, the same way every mature franchise system eventually has to. The restaurants that adapt, leaning into digital ordering, operational efficiency, and multi-unit scale tend to be the ones still standing profitably in a decade. The ones that don't are the ones most exposed when costs rise and margins don't move to compensate. So, is owning a McDonald's franchise actually a good business? The honest answer is that it can be, but it is neither passive nor easy, and it demands serious capital just to get through the door. It requires real operational skill to run day to day, genuine discipline around labor and food costs, and increasingly scale a handful of restaurants rather than just one, to make the economics comfortably work. But for those who run it well, and particularly those who build a small portfolio over time, it remains one of the most proven, systemized paths to real profitability that franchising anywhere has ever produced. The brand does the marketing. The system does the training. What's left for the franchisee to get right is simply everything else, and that, it turns out, is exactly where the profit is hiding. Because in the end, the Golden Arches aren't really selling burgers. They're selling a very well-designed piece of real estate with a kitchen attached.